Now let's move on to step 3 of the tenant screening process, income verification. Once we've confirmed the applicant's identity, the next question becomes, can the applicant reasonably afford the rent? At the end of the day, the single biggest predictor of on-time rent payments is having sufficient verifiable income. That's why income verification is one of the most important parts of tenant screening. Many landlords and property management companies use a written income standard as part of their screening criteria. A common industry standard is requiring household income equal to at least 2.5 times the monthly rent. This creates an objective standard that can be applied consistently to every applicant. Let's look at an example. Suppose the monthly rent is $2,000. Using a 2.5 times income requirement, we would calculate 2,000 times 2.5 equals 5,000. That means the household would need to demonstrate at least $5,000 in gross monthly income to meet the published screening criteria. Now, income can come from many different sources. When screening applicants, we're not looking only at traditional paychecks. We're looking at whether the income is lawful, verifiable, and sufficient to meet the rental obligation. Acceptable forms of income documentation may include recent pay stubs, tax returns, bank statements, and employment offer letters. Also, pension income, Social Security benefits, retirement income, self-employment records, and government assistance programs. One of the most important things Oregon landlords need to understand is that Oregon law protects lawful sources of income. That means landlords generally cannot refuse to consider income simply because of where it comes from. For example, housing assistance programs, Social Security benefits, disability benefits, and retirement income must be evaluated fairly. That's why you should focus on the amount of income, not the source of income. Let's look at a common mistake. A landlord says, "We don't accept Section 8. That statement creates legal risk because it excludes applicants based on a protected lawful source of income. Instead, the focus should always remain on the written screening criteria. For example, all applicants must meet our published income requirements. Now we're evaluating everyone using the same objective standard. See the difference? One approach focuses on the source of income. The other focuses on whether the applicant meets the published qualifications. Another best practice is verifying the stability of income. It's not enough to simply see a number on a pay stub. We want to understand, is the income current? Is it recurring? Is it likely to continue? Can it reasonably support the rent obligation? For example, a temporary job that ends next week may require additional verification. Likewise, self-employed applicants may need additional documentation, such as tax returns or profit and loss statements. Remember, consistency is critical. Every applicant should be evaluated using the same written income standards. When landlords make exceptions for some applicants but not others, they increase the risk of discrimination claims. The goal of income verification isn't to judge applicants, it's to determine if the household has sufficient verifiable income. When you follow written criteria and apply the same standards consistently, it becomes one of the most objective and defensible parts of the process. Verify gross monthly income, apply published standards, and accept all lawful sources. Verify ability to pay, not where the income comes from.